2026 is not just another year on the calendar. It could be the year that completely changes how money moves around the world. If you have been in crypto for some time, you already know that prices alone do not tell the full story. What really matters is adoption, regulation, and real money entering the system. And today, all three of those forces are lining up. The big question is simple but powerful. What happens to XRP when institutions finally step in at full scale? Welcome back to We Are Cosmic, the channel where we break down crypto, XRP, and global finance in a way that actually makes sense. No hype without logic, no fear without facts. Here we connect the dots so you can understand what is really happening behind the scenes. If this is your first time here, you are in the right place. And if you are part of the Cosmic family already, thank you for being here and supporting this journey. Before we go deep, let me say this clearly. This video is not about short-term price pumps. This is about structure. This is about regulation. This is about institutions, banks, asset managers, and governments preparing the rails for the next financial system. And XRP sits right in the middle of this conversation. 2026 is being discussed more and more as the year of institutional adoption of digital assets. Not because of speculation, but because the groundwork is finally being laid. Regulation is coming into focus. Market structure laws are being written. And once those rules are clear, trillions of dollars that are currently locked out of crypto can finally enter. That is where XRP becomes extremely interesting. Recently, we heard new interviews from Caroline Pham, former CFTC director, and what she is saying should not be ignored. She explains that institutions already operate inside futures markets with strict compliance, risk management, and governance frameworks. The pipes are already built. The moment crypto assets properly plug into these systems, liquidity improves, spreads tighten, and costs go down. That is exactly what institutions want: safe access, clean liquidity, and regulatory clarity. This is why listed spot crypto products and futures markets matter so much. When market makers provide real liquidity on regulated exchanges, it attracts real money, not retail speculation, but pension funds, asset managers, ETFs, and treasury managers handling billions and trillions of dollars. These players cannot touch assets that sit in legal gray zones. They need certainty, and that certainty is what 2026 is shaping up to deliver. Now let us talk specifically about XRP. Regulation will decide how XRP is treated in the United States. Whether it falls under CFTC-style digital commodity treatment or stricter SEC oversight makes a massive difference. But based on current drafts of legislation and previous court rulings, XRP has a very real path toward being recognized as a commodity-style digital asset, especially as the network continues to decentralize. That matters because institutions will only engage with assets that are liquid, compliant, and legally understood. XRP already has speed, low cost, and real-world payment use cases. Regulation is the missing piece. Once that piece clicks into place, the doors open wide. Guys, if you are getting value from this so far, please take 1 second to hit the like button and leave a comment. It really helps this video reach more people, especially during the holiday season when fewer people are watching. And speaking of that, I want to wish every one of you a Merry Christmas, Happy Holidays, and peace to you and your families. Thank you for making We Are Cosmic part of your learning journey. It truly means more than you know. When Congress passes a crypto market structure bill like the Clarity Act or a FIT21 style framework, it does not instantly unlock trillions of dollars. Once the bill passes both the House and the Senate and reaches the president's desk, the president signs it into law. But after that, regulators like the CFTC and the SEC must write the actual rules. These rules define what is allowed, what is not allowed, and how institutions can legally operate. Caroline Pham made this very clear. The agencies are responsible for turning legislation into practical rule books. That includes defining digital commodities, restricted digital assets, registration requirements, custody rules, trading venues, and compliance standards. This rulemaking phase is slow, detailed, and extremely important. Once rules are written, they are very hard to change. That is why regulators want to get it right the first time. We have already seen how this plays out in other regions. Europe passed MiCA in 2024, but it did not fully go into effect until late 2025. Why? Because every detail had to be carefully written, reviewed, and implemented. The United States will likely follow a similar path. That means even if major crypto legislation passes soon, full implementation realistically lands in late 2026 or even 2027. Now, here is why this matters for XRP. Institutions do not wait until the last day to prepare. They position themselves early. Banks, hedge funds, pension funds, and asset managers start building strategies, custody solutions, and products well before rules officially go live. This preparation phase is where smart money moves quietly. During the next 12 to 18 months, regulators will define which assets fall under the CFTC as digital commodities and which fall under the SEC as restricted digital assets. Current drafts clearly show an attempt to split the crypto world into these two buckets. Bitcoin and Ethereum are already seen as commodities. XRP sits right at the center of this discussion. Based on court rulings from 2023, XRP's situation is nuanced. Historical institutional sales by Ripple were treated differently than secondary market trades. Programmatic sales on exchanges were not considered securities. This distinction is extremely important because new legislation allows assets to transition. A token can start as security-like and later become commodity-like as the network decentralizes and gains real-world utility. This creates a very real pathway for XRP. If regulators recognize XRP as sufficiently decentralized and functional, it can move under CFTC-style oversight. That would be a major positive. It would remove uncertainty, reduce legal risk, and allow U.S. exchanges, brokers, and institutions to fully support XRP without fear of enforcement actions. Another key point Caroline Pham raised is the cleanup of past regulatory mistakes. She talked about fixing years of overly burdensome and duplicative rules left over from Dodd-Frank. By simplifying and clarifying requirements, regulators can save the industry hundreds of millions of dollars in compliance costs. Lower costs mean more participation. More participation means deeper liquidity. Liquidity is everything. Institutions care about tight spreads, efficient markets, and reliable infrastructure. Regulation creates the environment where that can happen. Once that environment exists, capital flows naturally to the most useful, compliant, and liquid assets. This is why patience matters. 2025 may feel slow. Prices may move sideways. Sentiment may turn negative. But under the surface, the framework for the next decade is being built. And when that framework is complete, assets like XRP that meet regulatory, functional, and liquidity standards stand to benefit the most. Where does XRP actually fit in the future regulatory framework of the United States? The answer to this question will largely determine how institutions treat XRP over the next decade. It will decide whether banks feel safe holding it, whether exchanges confidently list it, and whether large investment products can be built around it. The current direction of U.S. legislation tries to divide digital assets into clear categories. On one side, you have digital commodities overseen by the CFTC. On the other side, you have restricted digital assets overseen by the SEC. Bitcoin and Ethereum are already widely viewed as commodities. XRP, however, sits in between, and that is exactly why it has been so important in shaping crypto law. Based on legal analysis and the 2023 court decision, XRP is not a simple case. The court ruled that certain institutional sales by Ripple looked like securities transactions, while secondary market sales on exchanges did not. This distinction matters because new laws like the Clarity Act and FIT21 allow for something called a transition pathway. A digital asset can evolve over time as its network becomes more decentralized and more functional. This is where XRP has a strong argument. XRP is a fungible asset, traded globally on a public ledger. No single party controls the XRP ledger. Validators are distributed, transactions are transparent, and the network has been operating reliably for years. While Ripple holds a large amount of XRP, ownership alone does not equal control over the network. And future regulation may push Ripple to reduce holdings further, which could actually strengthen XRP's decentralization case. If XRP is placed under CFTC jurisdiction, the implications are massive. It would mean XRP is treated more like a commodity than a security. That would remove the biggest legal overhang that has limited U.S. participation. Exchanges could list or relist XRP without fear. Broker-dealers could support it, custodians could safely hold it, and institutions could finally step in with confidence. If XRP were forced under strict SEC treatment, it would slow things down. Disclosure requirements would increase, trading would be more limited, and institutional products would face higher barriers. However, even in that scenario, current legislation still allows assets to migrate categories over time. That is why decentralization and real-world utility matter so much right now. Decentralization is not just a buzzword anymore. Regulators are actively defining what it means. They are looking at validator distribution, network governance, token supply dynamics, and real usage. Assets that can demonstrate functionality beyond speculation will have a major advantage. XRP's role in payments, liquidity, and settlement gives it a strong position. Another important factor is political engagement. This is why leaders like Brad Garlinghouse and major exchange CEOs are actively working with Congress. If lawmakers get this wrong, it could harm U.S. competitiveness and push innovation offshore. The goal is to keep crypto activity in the U.S., not force it out. XRP fits that goal because it supports efficient cross-border payments and financial infrastructure. Over the next 12 to 18 months, regulators will finalize definitions, registration standards, and transitional relief frameworks. During this time, assets like XRP will be closely evaluated. Liquidity will concentrate around tokens that clear regulatory hurdles. Others will struggle under higher compliance costs or disappear entirely. This period will likely reduce the crypto market dramatically. Thousands of tokens with no real use case or central control will not survive. While that sounds scary, it is actually healthy. Capital will move toward assets that solve real problems and fit within legal systems. XRP stands to benefit from this shift. Now that we understand where XRP may fit legally, let us talk about what actually happens once regulatory clarity arrives. This is the part most people care about because this is where adoption turns into real demand. Regulation is not just paperwork, it is a key that unlocks entire financial systems that are currently closed to crypto. If XRP is clearly defined under a CFTC-style framework, or even as a restricted digital asset with a credible path to commodity status, the first major impact will be on liquidity. U.S. exchanges and broker-dealers will gain confidence to list or fully support XRP without fear of sudden enforcement actions. That alone increases trading depth, volume, and market stability. More liquidity means tighter spreads and less manipulation, which institutions require. Next comes custody. Institutions cannot hold assets without qualified custodians. Clear rules allow banks and regulated custodians to safely hold XRP for clients. Once custody is solved, everything else follows. Asset managers can create products. Funds can allocate capital. Treasury departments can manage positions. This is how real money enters a market. One of the biggest potential outcomes is the expansion of XRP-based investment products. Think ETFs, ETPs, structured notes, and managed funds. We have already seen what happened to Bitcoin and Ethereum once regulatory doors opened. Demand exploded because institutions finally had compliant vehicles to gain exposure. XRP could follow a similar path once legal uncertainty is removed. Banks and payment institutions are another critical piece. Today, many banks understand XRP's efficiency, but hesitate because of regulatory risk. Clear guidance gives them comfort. Banks could hold XRP on balance sheets, use it for liquidity management, and integrate it into cross-border payment rails. This is not speculation. This is exactly how financial institutions operate once compliance questions are answered. For Ripple, this clarity is just as important. When XRP no longer carries U.S. securities risk baggage, Ripple's enterprise products become easier to sell to U.S. banks and fintech companies. XRP becomes a neutral settlement asset on a public ledger rather than something tied to legal controversy. That shift in narrative is powerful. This is where XRP's role as a bridge asset really matters. Countries do not want to rely on each other's currencies for settlement. China does not want to use the U.S. dollar. The U.S. does not want to rely on China. Smaller nations want neutrality. A decentralized, country-agnostic digital asset that can settle value quickly becomes extremely attractive. XRP fits that role better than almost any other token. Another key impact of regulation is market consolidation. Assets that fail decentralization or functionality tests will face heavier disclosure and compliance costs. Many will disappear. This could wipe out a large percentage of the crypto market. While that sounds harsh, it removes noise and directs capital toward real use cases. XRP benefits from this environment because it already operates at scale and solves real problems. We are already seeing signs of supply tightening. Large amounts of XRP are being locked in funds, cold storage, and long-term holdings. Grayscale and other institutions are accumulating. ETFs and institutional products reduce circulating supply over time. When combined with growing utility, this creates a powerful dynamic. It is also important to understand that price may not immediately reflect this progress. Regulation builds slowly. Infrastructure takes time. But value tends to follow fundamentals eventually. This cycle is different because companies are building and generating revenue even during market downturns. That was not common in previous cycles. To truly understand why XRP could play such a critical role in the future, we need to zoom out. This is not just about one token or one company. This is about how the financial system itself is evolving. A powerful comparison has been made by major financial institutions, including Goldman Sachs, describing blockchain's current stage as the TCP/IP moment. That comparison is extremely important. In the early days of the internet, there were many separate networks. They could not easily communicate with each other. Then TCP/IP arrived. It standardized how data moved across different systems. Once that happened, the internet exploded. Innovation accelerated. New applications appeared everywhere. The same thing is now happening in finance. Today, there are more than 100 blockchains. Many of them work well on their own, but they struggle to interact with each other. This creates silos. Institutions do not want silos. They want systems that talk to each other. They want value and data to move seamlessly across networks, banks, and payment systems. That is where interoperability becomes the most valuable feature in the entire space. This shift strongly favors neutral infrastructure rather than single chain dominance. Institutions are not looking for the one blockchain to rule them all. They are looking for shared standards and common rails. Events like SIBOs have made this very clear. Banks and financial institutions are openly discussing standardization and interoperability. This is where Ripple's architecture stands out. The XRP ledger is designed for speed, low cost, and reliability. But even more important is the Interledger protocol. Interledger was designed to route payments across different ledgers the same way IP routes data packets across different networks. It does not care what system you are using underneath. It just moves value efficiently. In a world where multiple blockchains, banks, real-time payment systems, and digital currencies coexist, a neutral routing layer becomes incredibly valuable. Interledger can sit above all of them. It allows value to move without every system needing custom integrations with every other system. This reduces complexity, cost, and risk. XRP fits naturally into this model as a bridge asset. When liquidity needs to move between systems that do not share a common currency, XRP can provide instant settlement. This is not theoretical. This is already how Ripple's technology is being used in parts of the world today. As institutions adopt shared blockchain standards, demand shifts toward assets that support this interoperability. XRP does not compete by trying to replace everything. It competes by connecting everything. That is a very different strategy, and it aligns well with how global finance actually works. Another important factor is neutrality. Countries are increasingly sensitive about monetary control. A decentralized, country-agnostic settlement asset reduces political friction. It allows cross-border value transfer without favoring any single nation. That makes XRP attractive in a multipolar financial world. We are also seeing real supply dynamics emerge. More XRP is being locked up in institutional products, ETFs, and long-term holdings. When assets move into cold storage or funds, they are removed from active circulation. Over time, this can have meaningful effects on liquidity and pricing, especially when combined with growing usage. This is why many experts believe that only a handful of digital assets will truly matter in the long run. Assets that fail to integrate into this interoperable future will struggle. XRP, along with a small group of other utility-driven tokens, appears well-positioned. In the final part, we will bring everything together. We will talk about market divergence, why many crypto prices may fall while infrastructure assets grow, and what 2026 could realistically look like for XRP holders. As we bring everything together, one thing becomes very clear. The crypto market of 2026 will not look like the crypto market of the past. The idea that everything goes up together is slowly dying. What we are moving toward is divergence. Some assets will fade away, while a small group will separate and move on a completely different path. Many people expect prices to go down in 2026, and honestly, that may happen for a large part of the market. But price alone does not tell the full story. This cycle is different because real companies are building, generating revenue, and integrating with traditional finance even during slower market conditions. That is a major shift from previous cycles, and XRP sits right in the middle of it. As regulation becomes clearer, the market will start to reward function instead of hype. Tokens without real decentralization, real utility, or regulatory viability will struggle. Some will face heavy compliance burdens. Others will disappear entirely. This could eliminate a large percentage of today's crypto assets. While that may feel painful in the short term, it is healthy for the long-term growth of the industry. XRP is positioned on the opposite side of this divide. It has survived legal scrutiny, regulatory pressure, and multiple market cycles. It is deeply connected to payments, liquidity, and settlement, areas that institutions actually care about. As U.S. market structure laws move forward, XRP has a realistic path to clear regulatory treatment and institutional adoption. Over the next 12 to 18 months, rulemaking will continue. Agencies will finalize definitions, registration standards, custody rules, and trading frameworks. During this period, liquidity will increasingly concentrate around assets that pass decentralization and functionality tests. XRP is likely to be included in that group. If XRP receives favorable treatment or a clear transition pathway toward commodity status, the implications are significant. U.S. exchanges can fully support it. Institutional custodians can hold it. ETFs and structured products become easier to launch. Banks and payment providers gain the confidence to integrate it into real systems. That is how demand builds sustainably. We are already seeing early signs. Institutional accumulation is increasing. XRP is being locked into funds and long-term storage. Large players understand that supply dynamics matter. When combined with growing utility and regulatory clarity, these factors can influence price over time. Another key theme is neutrality. The global financial system is becoming more fragmented politically. Countries are competing, not cooperating. In this environment, neutral settlement assets become extremely valuable. XRP does not represent any single country or central bank. It operates on a public, decentralized network. That neutrality could be one of its strongest advantages going forward. Interoperability also plays a central role. Finance is not moving toward one system. It is moving toward many systems that need to communicate. XRP, the XRP ledger, and Interledger are designed for this reality. They connect rather than replace. That design philosophy aligns perfectly with institutional needs. This is why 2026 matters so much. It is not about instant gains. It is about structural change. It is about regulation catching up with technology. It is about institutions finally having the clarity they need to act. And when they act, they do so at scale. For long-term holders, the message is simple. Understand what you own and why you own it. Ignore noise. Focus on infrastructure, utility, and regulation. Those are the forces that shape decades, not days. I am genuinely excited about what lies ahead, and I am grateful to share this journey with all of you. If you got value from this breakdown, please like, share, and leave a comment. Your support helps this channel reach more people who want real education, not empty hype. This is We Are Cosmic, and 2026 is just getting started.